Hello, my name is Dana Wiklund, Research Director for IDC Financial Insights, covering global risk management. I'd like to welcome you to our video blog, and the subject of today's video blog is an overview of current enterprise risk management issues. Our first slide is an enterprise risk management heat map. When we look at integrated risk management, we think of it in terms of credit risk, market risk, operational risk, asset liability and liquidity risk, as well as sovereign risk. The two hotspots that we see as of today are relative to defaults and regulatory risk. So there's still a lot of issues in the industry over consumer and commercial loan defaults, and also risk managers are very concerned about regulatory risk and being able to comply with the changing landscape of regulation. Secondarily, we feel that the issues of asset and liability management, as well as identity and access management, or financial crimes and fraud, are secondarily very important risk issues. Subsequent to that, when we think of issues of market risk in terms of interest rates, when we think of strategic risk in terms of the ability of firms to control their business models and look at their strategic direction, as well as what we call people risk, or an operational risk that involves the stresses on human capital within companies. Also, anti-money laundering, fraud issues, compliance issues, and geopolitical instability sort of round out in sort of a third tier of risk. But the big issue here really currently is around defaults, both consumer credit and commercial credit defaults, and then also financial institutions being able to deal with increased levels of regulatory risk through their ability to comply with increasing regulatory demands. Our next slide is about solvency, period. When we think of solvency, we're moving away from the income statement, looking at the balance sheet. And when we're looking at the balance sheet, we're looking at sensitivities around assets, around liabilities, and around the capital position of the organization. So into this general model will go customer relationships. So financial institutions are putting a lot of attention into identifying who are their customers, how do they build those relationships, how do they manage and keep those relationships ongoing. To do that, investments need to be made in technology and in data, in understanding assets at the loan level, at the portfolio level, at the business unit level, and across the organization. Leading organizations are now looking towards intelligent business intelligence dashboards and devices to help aggregate out millions of transactions across hundreds of thousands of loans to try to give a sense of portfolio direction and influence on the firm. This is a necessary activity towards driving an overall business model strategy. And meanwhile, while all of this is going on, regulators are stepping up their needs for information, for methodologies, and for output reporting. All of this is taking place in an environment where the bigger issue seems to be emerging about how do we do this profitably? How do we comply? How do we understand our customers? What types of technology do we invest in? What types of business intelligence tools do we need? What is our business model strategy? Is all coexisting amongst the need and then to develop an ongoing profitable and viable business. So it's a very complicated situation, but the stability and solvency of the balance sheet is the most important aspect of managing financial institutions at the moment. Institutions are really struggling now with the challenges of increased regulation. So in talking to senior risk officers, it really is a matter of, well, we need you to go right. No, we need you to wait. Well, why don't you go left, but go right now? And, truly at a fork in the road. They're dealing with mandates of immediacy. They're looking to align data and analytics to meet demand list, not wish list from regulators. And when surveyed, bankers do not feel that primary intellectual property regarding liquidity and solvency of the institution relies or sits with regulators, but moreover within expertise in the firm or with smaller firms within broader industry consultancies that have a broad view. So whether it's upgrading to a data warehouse, whether it's investing in a new asset and liability system, These investment decisions are being clouded by a very chaotic regulatory environment as we sit here today. Now, as long as there's still a perceived level of underlying systematic risk, as long as there's a Democratic administration favoring increased regulation, we will continue to see stepped up regulatory pressure on financial institutions. And this is producing a lot of stress on institutions and trying to make the right decisions around data, around technology, and around methodology to deal with the increased regulatory demands. Capital budgeting continues to be a very important issue for financial institutions, and really the squeezes on, the pressure will continue to build through 2010. Continued intense internal capital rationalization around projects for new business initiatives, people, projects that involve data. Companies will be looking to renegotiate their contracts and lower existing expenses. We see continued analysis and movement towards services and software solutions, cloud computing solutions that lower the cost of ownership and speed implementation so that benefits can be gained. And we also see an increased financial discipline and sophistication with evaluations on technology projects. So really capital budgeting, especially with the specter of potential additional fees being placed on the financial services industry by the government, capital budgeting is a very large concern across many different organizations. I recently completed a survey of risk priorities through LinkedIn. And the question was, where should capital be invested this year for risk technologies? And I had a feeling that liquidity would play an issue over sort of traditional credit risk and loan defaults. And as it turned out, the concern was with liquidity. So 30% of people surveyed said that capital should be invested with liquidity and economic capital risk solutions in the next 12 months. 23% said compliance or regulatory risk. 25% what you might expect credit risk, sort of loan default tools to affect loan defaults. 12% said operational risk solutions, and then 7% said market risk solutions. So the upshot of this survey really is that there is significant attention and mind share on the part of risk professionals across the financial services industry on liquidity and asset liability sorts of solutions that involve solvency of the balance sheet, slightly more so than what you might expect in traditional credit risk and loan defaults. As we look ahead through 2010, we're probably coming through the backside of the storm where we might have felt we've been in the eye of the storm for a little while. I think what we can continue to see is risk aversions amongst financial institutions. Moving target of global regulation will continue. Continued issues around identity and access risk management. Data breaches will continue to be a concern. Traditional fraud and anti-money laundering, as well as the stress on the financial services industry. It's a real operational risk of human capital. Also, as well, issues of commercial real estate valuations, potential continued defaults in consumer real estate, and lastly, how to organize the data within the organization to better deal with risk issues. So there's quite a few issues which financial institutions will continue to deal with aggressively as we move through 2010. Thank you very much. This concludes our video blog for today. I would encourage you to take a look at our online community. You can see the URL on the screen. Many different blogs across the financial services space, discussion forums, as well as resources. And I appreciate your time today. Thanks.